Welcome back, investors. Today I want to walk you through a tool that I made a while back. I called it the Swiss Army Knife Intrinsic Value Calculator. Just a silly way for me to remember that it utilizes multiple valuation methods commonly used by value investors to come up with buy or don't buy ratings for stocks. As you can see here, these are manual entry. These are things you have to type in order to get these values to work. These are automatic entries. They utilize formulas that will automatically populate when you enter these. This section here is your various assumptions you might make that are going to affect the outcomes of the intrinsic values that you're getting. This, of course, is your current value that the stock is trading at, and so it's going to compare it to that to give you these buy or don't buy ratings. And then this as well is something that's going to be affected by the assumptions you place in here. Now, to get started, I want to talk about how this works, and then I want to kind of talk more about what it is, what these valuation methods are, why they're used, and some of the nitty-gritty of the assumptions that are made. I had a request to make this video because someone had purchased this through the link. They had some questions about things. I had gotten some other questions, and I was like, well, this certainly could help people not just use the tool that I made, but also if they're making their own tools, they're doing their own research, to understand how assumptions that we make in investing affect the outcomes in values that might affect our decision making in purchasing or not purchasing different stocks. So, of course, start here. Example, I used Walmart. It's showing don't buy. I could put in, let's say X, US Steel Corp. It's going to pull different stuff in. I have to manually enter a book value. Let's pretend it's $13. And that's going to tell me, oh, it's buy, except for don't buy in this case for the gram number. So we're going to go back to Walmart. I think that's what I had. Current yield of AAA corporate bonds, 5.05%. Risk-free rate of the 10-year T-bills at 4.26% as of today. Average yield of AAA corporate bonds at 4.4%. And I believe that's over like 50 years or something. Of course, when we entered this, just to show you, so again, we'll type in X. Now watch these numbers here. When we hit enter, they all change. And so you might be asking, well, how did you do that magic? It utilizes Google Finance formulas. These are not available in Excel. You can get similar information in Excel through their stock formula, not really formulas, but stock data functions under the data tab, similar to this here. However, there's some stuff that you can't get that Google Finance formulas allow you to get, and so that's why I created that here. It's quicker, it's more up to date, and it was easier for me to share with people. So again, we'll pull in price, Google Finance, C7, which is the ticker, and then we want price, price earnings. You can get that, or you can do the formula for it because it'll pull in the current earnings per share, and then of course the beta as well will pull in. And then price per book is actually done. Remember, we had to manually enter book value per share. I get that usually off just Yahoo Finance or Seeking Alpha. And so again, calculation there because it's pulling in current price from here. So very simple. Again, you have a couple manual entry things. These are manual entry as well, but these are assumptions. These are what they are. And it's going to affect these automatic items here, which then will funnel in down here. As you can see, you've got a different formula for each of these different valuation methods. Now, of course, these two things here, kind of their own just comparison items: percentage of current price that the intrinsic value is, the price difference, of course, and then the acceptable buy price at your set margin of safety. So this is what you should buy it at if you want to buy at a margin of safety to what you believe the intrinsic value to be. So again, you may say it's 46.71%. Well, up here we enter a preferred margin of safety. So at 20% margin of safety from 46.71, we might buy it at 37.37. Well, 37.37 is much lower than the current price, so you would be overpaying for it as of today. So it's a don't buy. Of course, if you had much lower margin of safety, 164.33, it's just a little bit greater than 163.77. Say you had no margin of safety built in, you would say that's a good buy. You know, at least in the sense that you would make just under $1 by buying it. Now, of course, these are driven by these. So if I make changes up here in this section, that's going to affect the kind of acceptable buy prices that I get. And so what's needed in order to use this to any degree of reliability, which I'm going to add a caveat to in a second, then I need to understand what goes into the assumptions, kind of the guesswork, so to speak, to dictate how these are made. Now, the caveat, of course, is I've used this in the past more for a screening tool than anything else, because, you know, I want to find companies that maybe, you know, using these value investing formulas come out looking favorably to some degree. So I'll quickly type through different stock tickers and their book values, kind of see if I'm getting buy or don't buys, usually in the more conservative columns here rather than the aggressive columns. And if I can get a lot of buy ratings, then, you know, typically I'll go and do much deeper research. If you've watched any of my other videos, you know that I do a lot of other quantitative analysis. I'm using a blend of income statement, balance sheet, cash flow statement. I'm using those all together. I'm also, and of course, over multiple years, at least 5 years, and I'm using qualitative analysis to look through the annual reports, the 10Ks, to understand competitive advantage, and different factors that allow a company to stand out and become a good investment. So again, caveat there, I would not necessarily make all my buy and sell decisions based off a tool like this, but it's helpful as a screening tool, as understanding maybe some of the general metrics that affect whether something's worth buying. Now, of course, if you put in, so Walmart, you get some of the similar things. Well, a company like, company like Amazon, well, they're going to have very different ways they're valued. So 138.23, well, it's telling me it's only worth 11 to 28.94. I don't know that that is necessarily accurate, because Amazon is functionally a very different company from a retail company like Walmart, or a manufacturing in raw materials company like U.S. Steel Corp. And so, you know, depending on the sector you're looking at, this may not be super valuable. Now, if I'm looking at like Bank of America, of course, I'd have to go and, you know, I want to look up their book value per share. Book value per share is at least somewhat useful with bank stocks. There's some reasons you need other things to look at with a company like Bank of America, but say that's all we want to look at. Well, 3205 is what's said to be the current book value per share. Well, we get some buy ratings, right? So maybe it's more useful for certain companies compared to others, and there are reasons for that. Now again, diving into what these are. So these three things, and there's actually a fourth model in here. This one is almost solely manual entry, which is why I've kind of set it aside. This is the dividend discount model, or the Graham growth model. Again, different grams for all three of these. This one looks at based off the dividend growth, what I might assume the shares are worth. So very different looking at this sheet, how one might value a stock compared to these three things. Now the gram numbers is probably the simplest. That's why it's the same across all four, is because it's just the square root of 22.5 times the current earnings per share times the book value per share. That's why it doesn't differ between how conservative or aggressive you are. It is the same number no matter what, depending on the book value per share. Now, Graham growth stock formula was one I was really interested early on. I'd made this nifty little tool, and it's based off of this formula. This is actually Benjamin Graham, the father of modern value investing, and Warren Buffett was his protege. He wrote The Intelligent Investor. He wrote Security Analysis. These are foundational texts on value investing. And he'd come up with this formula for looking at basically the bare minimum value of a company, and it essentially looks at earnings per share times 7 plus 1 growth rate projection times 4.4, which is the average yield of AAA corporate bonds, divided by Y, which is the current yield of AAA corporate bonds. As you can see here, much less than the current rate I'm using in this tool because I made this a long time ago. And of course, I also have done 2 in my growth multiplier. So 1 times G, the growth rate projection, which I just had at 5. And that as well will give different, based on current price, different, same margin of safety, what my buy ratings might be. Of course, similarly, we might look at PG, Procter and Gamble. Okay, it's telling us don't buy because it's significantly, here it's kind of close if we use a 2 instead of a 1, but even still our acceptable buy price is much less than the 152.93 it's currently trading at. And then of course I had here a simplified gram number because again it's the same no matter what, as long as you have the book value and some of these other assumptions. Well, earnings per share is really all you need. So that's built in there. And then this third formula, come back here, discounted earnings model. This is the most complicated of the 3 and requires the most assumptions. I'd originally created this fun little calculator because I was trying to figure out, originally I thought, well, I want to do discounted cash flow. It's what everybody uses to determine what a stock's worth. Well, there wasn't a quick way to screen stocks with a discounted cash flow. As far as a point and click, type the ticker and bam, I get my discounted cash flow intrinsic value amount where it's based off my own assumptions. There are calculators out there you can supposedly put information in and it'll give you an intrinsic value. Of course, I'm one of those people, I don't let other people change the oil in my car because it's not necessarily paranoid, it's more just I'm picky. I want to know it was done right, or if I messed it up, at least I know I messed it up and not somebody else, and I just trusted the wrong person. So that's part of why I like to do things myself, is because I like to make my own mistakes, I guess, and learn the hard way. Regardless, I created this little calculator, and of course, with this, the basic essence of what this is saying, okay, if we get the present value of earnings per share over 5 years, of course it'd be more reliable to use maybe 10 years plus, at a given discount rate, then we add that to the terminal value, which is just the total earnings that a company might bring in over the life of the company, so perpetual, to the end of time basically. So 2864 in earnings, supposedly at a perpetual growth rate of 0, then this would be our intrinsic value, because again we have our present value, and then we have to take our present values of all of the earnings of the next 5 years plus the terminal value. Now, of course, we're using a really high discount rate. Say we took, so again, we have some of these formulas in here. Say this is to calculate the capital asset pricing model, which if you don't know a lot about, there's a lot of information out there. You're essentially taking the risk-free rate, adding that to beta times your expected return in the market minus the risk-free rate to determine what the expected return of your investment should be. So again, this, before things changed, it was 3.33% on 10-year T-bills, had a beta of 1.39 for GM. Over 30 years, let's say we could get 11%. I think it's closer to 9.89. Then our expected rate of return would be 13.99. So say we use our discount rate, it's going to be 13.99. That's what it's got to get. Say our perpetual growth rate, it's going to be closer to, let's say GDP averages around 0.02. I think it's closer to maybe 3, but it's, fluctuates. Then our intrinsic value is going to be 96.71. Of course, the lower our perpetual rate, the lower the intrinsic value. The higher our discount rate, the lower the intrinsic value. So again, depending on what kind of assumptions you use, most analysts out there are going to use your capital asset pricing model. I don't necessarily like it because it hinges too much on the beta of a stock. It's the assumption that the more the price moves in the market, the less valuable necessarily a company is. It's too risky. Well, price fluctuation happens. It's based off buying and selling behavior, not necessarily the behavior of the company. So I don't necessarily love the capital asset pricing model, but it is generally accepted by a lot of people. The problem that I find with it when looking at a calculation like this is you end up with 0.139. I'm much more comfortable with 0.25, and so my intrinsic values are always going to come out a lot lower than what it would if I use the capital asset pricing model. So just diving back in again, what we put in here affects what comes out down here, and therefore what this conditional formatting shows here. Again, your preferred margin of safety. This technically should be backwards. It should be 50% if you're more conservative. I flipped it because, I need a higher margin of safety if I'm going to be very aggressive, whereas I need if I'm already being very conservative, maybe I need a less large margin of safety because I know, okay, maybe this may already be too conservative. So that's why I'd flipped it. Again, your perpetual growth rates starting at 0 up to 3.15%. No company grows forever, just a fact of life. And then again, assuming the price earnings of company with no growth, going back to our Graham intrinsic value, our price earnings just always going to say somewhere around here. And then again, growth rate projection, growth multiplier, and then our terminal value is going to be determined either based off the discount rate we give or the capital asset pricing model for that stock. So essentially that's how we come to this place. The last thing I have here, this is built into my personal spreadsheet. I don't have it in the sheet that's available through the link on my profile, but I like to also look at net working capital when I'm really interested in screening companies. This is just really manual, that's why I didn't include it. But of course you have your margin of safety. Net working capital is your current liabilities minus your current assets minus your current liabilities. Well, net working capital is your current assets minus your total liabilities. And then, of course, if you want to be like Benjamin Graham and say, well, we're going to liquidate the company tomorrow, what would it be worth, which is called cigarette butt investing, then we're going to discount then, which again, not to be confused with discount rate, but we're going to discount what these different current assets are actually worth. So 75% for receivables, 100% for cash, 50% for inventory, 40% for other current, because we don't know what it is, minus total liabilities. We then would find that value, divide it by outstanding shares, And that's going to bring us to the current intrinsic value. Again, take our margin of safety to get a buy price, and then we get a buy rating. So that's just more something for myself that I enjoy messing around with. Again, this is a tool that I made mostly for myself again, but I found that it's helpful for other people, helps you dip your toe into value investing, different models that are out there, and really just fun to mess around with compared to some of your other research. If you have more questions, definitely drop those in the comments. If you noticed I got a formula wrong or said something really, out of place or dumb, so to speak, definitely let me know that as well. I definitely love feedback, even bad feedback. I appreciate it because it helps me to improve. If you have requests for future companies to evaluate, definitely drop those in the comments. I do try to keep up with those. My hope is to continue to be very consistent over the long term. I do hope to eventually walk through a couple videos that would show you how to make this for yourself. Again, I'm not out to just sell a bunch of copies of this and make money off my subscribers. I'm more interested in helping people invest and invest well. I also know that your time is valuable, and so maybe it would help you just to go ahead and buy it and tinker around with it yourself. So that's why it's out there. As always, it helps me if you like and subscribe. It also helps you if you like and subscribe, because then you don't miss future content. And of course, I always say this: dig in, invest well. I hope to see you next time. And just look forward to growing on this investing journey with you. So until next time, this is the value formula, and this is the Swiss Army knife intrinsic value calculator.